Ciao ragazzi. What's the better way to start the morning than the RWA panel, right? I'm gonna be a moderator today. I'm Nick from Cointelegraph. Cointelegraph is the biggest and the oldest media outlet. Amazing lineup of speakers we got today. The people that are bridging RWAs with blockchain technology, making it more accessible. Got a bunch of questions, so ragazzi, let's let's start with just a brief introduction of yourselves and how do you personally contribute to RWAs?
Should I go ahead? Cool.
Per favore.
Thanks, Nick. Good morning, everyone. Thanks for being here. The first talks at a conference are typically a bit less crowded, so thanks for coming early. My name is Markus. I'm working on Mento. Mento is a stablecoin platform for local currency stablecoins. We are focusing on, let's call them long-tail currencies. We just launched a Kenyan shilling for like micro lending projects in Kenya. We also launched a Philippine peso. We have a euro, a dollar, a Brazilian real, a West African franc stablecoin. For us, the RWA space is really interesting because in the end, for these exotic currencies on chain, we need all sorts of collateral that can also earn yield, that can diversify the risk in the collateral for these stablecoins, and this is why we're looking into RWAs. Yeah, looking forward to this panel.
Hey everyone, nice to meet you all. It's awesome to be here as a Milanese speaking about crypto here in Milan. It's a real honor. My name is Emanuele. I lead the sales at Mountain Protocol. We are the issuer of a regulated permissionless yield-bearing stablecoin. That simply means that we've taken the model of a tether or a circle and enhanced it with the rewards component, essentially paying rewards to any holder of the stablecoin without having them need to do anything, no staking, no claiming or anything like that. Before Mountain Protocol, I was at Bloomberg. After that, I was at Coinbase within the prime brokerage business and running the tokenization business as well. And it's awesome to be here, and I'm very excited for this panel.
Hello, hi, Giorgio. I'm from Backed. Backed Finance is a company based in Switzerland that basically allows everyone to buy bonds and stocks on chain. You can buy it on mainnet, so on Ethereum, and on 9 layer 2s. We went live 2 years ago. We made around 70 million TVL and 100 million in total volume, and our first product was a T-bill product, so bonds of the US Treasury, and we just released a number of stocks. Personally, I'm based here in Milano, and I come from a fairly strong, I would say, a fintech background where I did N26, SumUp, and Funding Circle in London. And I've been working in crypto since, I've been active in crypto since 2014, more or less.
Thank you so much. Our panel's topic is RWA, which is very general. So let's get back to the roots. And I want to ask you, how did this concept evolve in general? Like, how did RWAs appear in the blockchain space? And what current developments shaped the current state of that niche?
Maybe I'm happy to take it first. So RWAs is just a rebranding for tokenization, a new narrative, let's say. The reality is that tokenization has been around at this point for many years with the advent of smart contracts and the first programmable blockchains. Back in the days, the success of these projects was not clear. The goals that these projects were trying to solve was not clear. There was always the promise of liquidity for, again, illiquid assets, real estate, private debt, and so forth. But the infrastructure and the market participants were just not ready to leverage these solutions. Even before that, there were already tokenization exercises taking place through private permission and blockchains like Hyperledger, R3 Corda, and so forth. But again, that is not crypto. That is not what we're all working towards. last few years, there has been a renewed interest thanks to a lot of great, large, sophisticated institutional investors and partners joining the space that are understanding the technology, understand what it can do for the traditional financial markets, and these critical mass has again brought RWA back in the spotlight. I would say that in the end, crypto as an industry right now, it's a lot of trading, speculation around tokens, coins, building a lot of DeFi primitives that ultimately in the long term will serve many of the traditional financial services that right now are sitting in the hands of banks and traditional financial institutions. So a lot of interest, a lot of crowds jumping into the RWA space. Again, in the end, it's nothing new. It's just that now we have reached that critical mass. The infrastructure is good enough. The market participants are sophisticated enough to make sure that we are successful.
I think it's a really good point. Infrastructure wasn't there over the past years. It's now improving a lot on like the custody side, on like all parts of the stack of a tokenization process. In addition, I would also say it's interesting that finally now regulation is catching up. I think tokenization of real-world assets was always a big problem for regulators around the world because now you bring like maybe even financial institutions into this game, which was hard. And now with a new regulation here in Europe, for example, with MiCA, the Markets in Crypto Asset Regulation, there's actually now a framework so that also institutions can engage in that space.
I tend to disagree with them. I think that what really changed is the interest rate. So pre-2023, the interest rates at global level were too low to make a bond on chain interesting for an investor. Like there was no point in investing in T-bills if you were making 0 or 0.1%. With the interest rate going up, the appetite for investors to buy, even crypto investors, to buy T-bills initially grew. And with the explosion of with T-bills growing to, let's say, $500 million around, then the interest for other type of products on chain grew. I think that was really like the biggest difference. Of course, like I agree with Emanuele, there was an infrastructure play, more infrastructure were built, but without low interest, higher interest rate, it wouldn't have happened, I think.
I love this little debate that we had here. I was waiting for that word, Markus, the trigger word, regulation. So regulation is an integral part of RWA's discussion all the time. I feel like all the time I attend RWA panels, it's like 80% about the regulation. I'm not gonna keep it 80% today, but what's the current state? Like how is the regulation going? How's the MiCA going? Like just a quick regulatory overview from your side on RWAs.
Okay, first, I think regulatory-wise, we offer security to our clients. We have a license. Our products are licensed. I think outside of the US, there is not a big regulatory issue in the sense that you have not certain, but kind of certain framework in which you can operate. The problem is right now that the biggest capital market in the world, it's pretty uncertain to invest in terms of resources because probably the elections are gonna change what the crypto regulatory ecosystem will be in the US. And so every project doesn't really invest in that market, even though it's the biggest one in the world. So I think we need clarity on the US because that is going to really drive adoption.
Trump or Kamala?
I mean, no, I'm not going to say it here.
Yeah, I agree. I mean, the US is a key market for global adoption or any financial products. You know, we cannot yet figure out whether Ethereum is a commodity or a security, and you know, that feels like something that we should have been figuring out quite a long time ago. Other than that, I agree with Giorgio. There are pretty clear regulatory frameworks across the world in terms of what can be brought to market with what structure. there is still, I think, a lot of work that needs to be done to harmonize these different regulatory regimes and to make sure that regulation is staying at the same pace of blockchain technology, which is a global decentralized ledger that runs 24/7. Global ledgers means global markets, and you're going to need to have some degree of global regulation can handle all of these different type of products.
Yeah, I agree. From our perspective, launching in more exotic markets in Brazil, in Kenya, and so on, especially there, regulation is a bit behind. They're still looking into what is the US doing, what is happening in Europe. For us, it is necessary that also in these countries, at some point, there will be tokenized real-world assets. For example, tokenized government bonds in Brazil would be good collateral for a Brazilian stablecoin, so that basically a stablecoin platform doesn't bear any FX risk. In Brazil, this is now happening. In Kenya, not yet. In the Philippines, it's just at the beginning. So yeah, it's as you said, there's no global standard, and certainly some countries that are still far behind.
Markus, you actually mentioned the emerging markets for several times at the beginning of this panel and now, so I'm very interested of, you guys launched tokenized currencies in South America, in Africa. What's the situation over there, like a quick overview? And obviously RWA is a positively influencing those markets, but are there any like bright use cases that you could highlight how RWAs are beneficial for the emerging markets?
I think having a yield-bearing stablecoin in US dollars is amazing for users, especially in these countries where there's both high inflation and local currencies that are losing value against the dollar, because then people actually get access to a stable currency. They maybe even get access to US Treasury yield. They can save. But at the same time, there are more use cases that should and are coming on chain. Another use case is, for example, credit or loans. We've recently done a longer research trip in Kenya and visited local lending circles. There, since people don't have access when they want to build out a business to a loan from a bank, they often form trusted circles of people in the community that can lend each other money. However, they need capital in these local lending circles. And when you're building a business and your revenues are in local currency, then you don't want to have a loan in US dollars, because then you actually have an FX risk. If your local currency loses value against the dollar, then paying back that loan becomes expensive. So one of the biggest use cases we are seeing there is actually microcredit in local currency and saving in global currency or in dollars. And therefore, for the real world asset space, if both need to exist, dollar stablecoins and local currencies stablecoins, then we also need tokenized real-world assets as collateral for these.
Yeah, maybe a comment there. If we think about RWAs and tokenized assets, stablecoins are the original tokenization use case. They're tokenized dollars, again, brought on chain, accessible by people all over the world. If you think about having a wallet, Phantom, MetaMask, whatever you want to call it, now anyone in the world, just by having access to the internet, also has access to a bank account, effectively. So stablecoins are a very powerful solution, and that's why there is so much interest from so many companies, whether it's crypto native or traditional, to join the space and to join this race. Of course, other than the fact that it's a very lucrative business. Aside from stablecoins, aside from stocks, treasuries, and so forth, my thesis around debt specifically was that tokenization can act as the financing layer for long tail markets, emerging markets and so forth, we are seeing over the last few years with over-regulation in the banking sectors, all of these financial institutions pulling out from all different type of financing and credit deals, and there is this credit gap, right? Someone needs to fill it. Now, who's going to fill it? My view is that, again, these tokenization platforms that are going to be focused on very niche markets, on very niche financing use cases, will fill that gap. And the great thing about blockchain is that the financing can come from anywhere. And you're starting to see private debt shops that are basically, again, using these as origination channels. You're starting to see crypto-native credit funds that are starting to deploy capital in this type of strategies. The challenge is always counterparty risk, right? How do you assess the risk of a blockchain platform without even knowing who they're financing, what deal they're working with? And you see some failures, you see some wins. In the end, this is an iteration process, but it's a very powerful new dynamic that has been enabled thanks to blockchain.
Yeah, I mean, they said everything, I think, but like, we firmly believe in stablecoin in the sense that stablecoin is not an opportunity, stablecoin is a reality. There are 150 billion almost of stablecoin circulation. And we think that with the next iteration of the markets that this could go 10x and become like a real force in the world of finance in general, because right now it's, yes, it's strong for crypto, but in the wider scheme of things, it's not that big. We think that with the next iteration that could grow yeah, kind of exponentially, and we're trying to position ourselves to provide a constellation of services around stablecoin. That's why we released the stocks that you can buy with stablecoins. So yeah.
Yeah, and maybe one comment there, the stocks on chain seems like such a simple idea, but actually is an extremely powerful new product that can serve customers all over the world. Again, stablecoins, access to the dollar in markets all over the world. These markets don't have access to the stocks, to US markets, to the S&P 500 and so forth. Companies like Backed are now enabling people in these jurisdictions with a wallet, with access to this digital dollar to get exposure to this asset class. And my view, and probably you guys think the same, is stocks are a start, there is debt, there is so many asset classes that, again, can be brought on chain and can serve these underserved communities.
No, 100%. For us, blockchain in general has to work a lot on distribution. Like over the last, I don't know, 5-6 years, there was a lot of effort on infrastructural plays, on like building kind of deep tech. But the real game changer is distribution. The most successful product is Tether. That is probably the dumbest stablecoin ever developed. There is no algorithmic pegging. There is not a real complexity behind it. It's the most successful because they nailed distribution. We think that through blockchain, we could reach new audiences and new targets. And that's where we're investing our time.
Cool. I do have a feeling like not as many retail people are interacting with RWAs as they could. I would say that most of the newcomers in the crypto would rather interact with the meme coins than with RWAs. And it brings me to the question about the user experience in RWAs. So what's the state of it? What's the quality of it? Can it be considered a blocker at this point? Is RWA's UX is something that blocking masses of people to interact with that technology?
I think actually on the user experience, the industry made like huge steps forward. There are already like all sorts of, for example, mobile wallets that allow you to hold tokenized RWAs relatively easily, easy to use wallets with account abstraction and so on. All of this already exists, but I think the key why this is currently still not broader is actually the point that Giorgio brought up, is distribution. I think that is a long game, and this industry didn't like have the the best approach to it, with sometimes hyping the wrong things, and therefore, yeah, distribution for me is actually key. It's much harder than fixing the UI.
Yeah, and infrastructure and distribution in the end are one and the same. If you think about using crypto nowadays, I was buying a random token this morning, and every time I use my wallet, I'm reminded why it's so hard for mass adoption, right? You need to buy crypto, you need to pay gas fees, go on the DApp, am I getting scammed, am I not, check the smart contract. People have no idea about all of this stuff, they don't want to deal with this stuff. So how do we get rid of that process? And we're seeing more and more examples where we are getting rid of all of that, especially through account abstraction and other sort of operations. And maybe a quick example, the team of Mountain Protocol is all from Argentina. They all live in Buenos Aires. Argentina is one of those key markets that you use as an example for why you need crypto, why you need stablecoins and so forth. And they have developed a fintech application where people deposit their Argentinian pesos in basically a fintech, and in the back that peso is converted instantly in USDC or other dollar-based stablecoins to avoid having to basically deal with all of that I just described. The user experience is great. I have $1, I don't know I'm touching a stable coin, I don't know I'm touching crypto, and in the end I get my goal, which is a stable currency, avoiding inflation and all of the problems that come with fiat markets, especially in this type of emerging economy. So that's the end experience, the end goal that we're going for, and again, integration of crypto projects with fintechs, with traditional financial platforms are gonna really help scale and distribution, and that is of course gonna require some technology work, it's going to require some regulatory work, it's going to require quality products, and I think that's what we're all working towards.
I think user experience is a relative game, in the sense that it depends on where you start. Like if you are from Argentina or Venezuela and you want to have access to dollars, you have a black market, which is much more complex than having a wallet and buying Tether. If you are in Milano, it's much easier to get access to US dollars. So the UX gain that you get through blockchain is relative, because you start very low in Argentina and Venezuela, you start quite high in the Western hemisphere. So starting from this assumption, I think that the current user experience for emerging markets of crypto products is decent. Is it perfect? No, it's not perfect, but it offers a tangible value, and that's why there is adoption there. Because you have millions of users trading on Tron or on mainnet with USDT. If we want to, anyway, we have to work a lot to improve the user experience for the rest of the world. Our standard, it's pretty, our bar is pretty high, and we're trying to get it, but we're not there yet. Because right now, for a user to buy a stock, it's much easier to buy it on Trade Republic or on traditional broker than on Bakkt. We know it and we're working for that, but we think that right now our target is the emerging markets. We're going to chase the emerging market clients because we think that the market is there and we have to survive.
When it comes to user experience, a nice example in emerging markets is actually a wallet called MiniPay by Opera. Opera is this browser that, especially across Africa, still more than 100 million users are actually using. Inside that browser, they have like integrated a wallet that is super lightweight, less than 2 megabytes, because data is expensive in emerging markets and in frontier markets. And this wallet abstracts away all this like Web3 experience you mentioned when you were buying this token this morning. Many of the users probably don't even know like what technology is behind the wallet. It's just a very easy way. You can use your phone number as a way to identify users and to send them money. So you can send, as long as you know the phone number, you can send them, for example, stablecoin. You can even pay for gas fees in stablecoins. So in this wallet, you actually only have stablecoins. And I think we need more projects like this that are abstracting this whole like Web3 experience away and make it really, really easy to use.
And maybe another comment based on what Giorgio said. Europe, United States, the banking system works relatively well. You know, in Europe, transfers, wires are near instant, from my understanding, with SEPA and other type of payment rails. In the United States, it could be better, but again, it still works. In order for stable coins to gain steam, because stable coins and crypto in general are a better technology, so it's going to happen, they're going to become the replacement for this legacy system, you need regulatory clarity. So you need the United States government to come in, to put in clear rules that would allow companies, banks, financial institutions, fintechs to upgrade their technology stack and to start relying on these new rails, on these new products.
In Europe, it works well as long as you're staying in Europe and not sending from Europe to the US, for example. Then it already becomes a bit more tricky and expensive and slow. So I think also even in the areas where the financial system works relatively well, there can be a lot of improvements in the cross-border, for example, business.
Yeah, we started the conversation about the UX, but ended up speaking about the cost of data, the regulation, all the complications. So yeah, it's impossible to discuss UX without all of those things. But I just came back from Singapore, and honestly, account abstraction, chain abstraction, it was such a buzzword there. Like everybody was speaking about them. It feels like it's like a new black, even though it's not like really new technology. So my question to you guys is, let's dive deeper into abstracting different, like, how can we make it hassle-free? And do you think that account abstraction, this technology, is integral part of the future developments of RWAs?
I can go first. Yes and no. In which sense? I think yes, it's going to be crucial, but it's not enough. Like we can't, I think there is tendency in crypto by far that we think that technology is going to solve all the problems. But technology itself is a tool. If you don't apply the tool to the right problem and you don't understand the deep causes of the problem, technology will never solve it by itself. So account abstraction is another example of this. We think, okay, we throw account abstraction at the problem and the problem is going to be solved. Now mass adoption is there. It doesn't work like this. Like you have a tool, but you have to model the tool around the problem to make people's life better. And account abstraction is another element that we can leverage to build successful solutions to real problems. It's another weapon, but it's not the silver bullet.
Yeah, but I think it's quite vital when it comes to the end user experience, because, I mean, it all starts with, hey, how do I start, right? And when users don't really understand, like, how can they interact with RWAs, that's where this technology kicks in and helps us, let's say, at the top of this user onboarding funnel to RWAs.
I agree. Is it working? Maybe. Hello. I agree 100% with Giorgio. Account abstraction is just technology. It's key for adoption, but it doesn't solve problems. And when I was at Coinbase and we were trying to crack distribution for RWAs and what the right model was, you can create an experience where people do not know they're dealing with wallets, but what problem are you looking to solve? Payments, stable coins, that's something that I think the market has identified as a problem. That's something that stable coins have found product market fit for, but you tokenize real estate assets, very esoteric type of assets. You put a nice account abstraction layer to it and expecting people to come and starting trading these assets like stock or crypto. It's not going to happen likely, right? These are liquid assets. They're going to stay liquid assets for a reason. So I agree technology is part of it, but identifying the problem, tackling the problem, solving issues that people see in the real world, like Opera Mini is doing, like you guys are doing with stock, that's really the key starting point. And again, technology is a way to reach that end goal.
Yeah, I agree. It's like you need to solve a problem, and then account abstraction is maybe one part of the user experience that improved over the past years, and there are more parts. Having like usable, proper like custody setups, having like fast, cheap transactions, having the also ability to pay for transactions in different currencies. For example, in a stablecoin wallet, paying for gas fees in stablecoin is something that is, from my perspective, as important as account abstraction for the end user experience, to make it really, really easy to send stablecoin from mobile phone to mobile phone, for example.
Cool. I wanna also talk about the builders, about the developers, because from one side we're saying that development is so fast, so the regulators cannot really catch up with us. But from the other side, we spoke about the thing that the infrastructure was not there like a couple of years ago. So my question is, speaking of the developer experience, what's the current state? Is the necessary tool set in place for that? How are we building it all?
My answer is very simple, yes. I don't think we have problems of infrastructure right now. Infrastructure were overfunded over the last 3-4 years, or the last 2 cycles, I think. There are hundreds, if not thousands, of chains. There are hundreds of dev tools that supports development on chain, but there are no clients. So like there are a few chains that found product market fit and have enough clients, but it's a tiny minority of it. So that is where people have to invest time, finding clients, not building another infrastructure play, which could be a good VC play if you want to fundraise, because VCs tend to fund what they don't really understand, I think. But I don't think it's good for the industry, or at least we don't think it's good for the industry, and I think many other players think like us.
Do you have anything to add on?
Yeah, I mean, I agree 100%. Infrastructure is there. Can it be refined? Of course, but there is plenty of ways in which people can build and bring this product to market. Again, it's about the problem, about the client that you're trying to serve. How are you making their life easier? Again, stablecoins, Opera Mini, other stablecoin super apps clearly are serving a purpose, because there are people all over the world that need this type of assets. Tokenizing random products, expecting people to come, show up and buy them, it's not going to happen. And you are seeing, I think, some issuers, some companies playing around some of the current DeFi dynamics together with tokenization as a way to bootstrap some liquidity and to try to get adoption for this type of products. But I think we all work in crypto, or more or less, we're all crypto curious. Once you start working in this space for some time, you start to understand how things work. In this corporate rate environment, there is a lot of capital that is just being recycled around the ecosystem, moving from protocol to protocol, capturing incentives. DeFi is a very mercenary type of industry, and the new capital is not going to come from it. So again, you really need to crack distribution. I think the participation of large institutional players, asset managers like BlackRock launching tokenized funds, private credit shops like KKR, Hamilton Lane launching private debt funds on-chain, these are all good signals that turn eyes of sophisticated individuals, mainstream investors to blockchain and to tokenization. But again, it's all about distribution. It's all about figuring out how to get the products in the hands of the right customers.
That's a very good point. I mean, capital in the space still is there where the incentives are, and if the incentives are gone, then often capital is also gone, which makes DeFi so volatile. So if we're actually able to execute on these real-world use cases, on bringing real end users into this technology, then we actually create something that is much more sticky. Because if you get a loan on-chain, or if you have like a certain trade that you have to do on-chain because you, for example, need to hedge your FX risk or something, then you have to do that no matter if it's currently DeFi summer or winter, or no matter if currently incentives are there or not, you have to get that loan, or you have to do that FX hedge. So I think that is actually the nice thing about that space, that it can bring sticky demand to what we are all building.
Yeah, these new products that are being tokenized, again, will all leverage at some point the primitives that we've been building over the years. Again, perpetual exchanges, lending protocols, and so forth. Again, taking a loan against a tokenized stock on something like Aave, right? These are real use cases that we will see at some point in the future. There is a few obstacles on the way, regulation, some technology, some UI, UX work, but we will get there. And again, this is how we really bring masses to the markets. If you think about, again, something like I just described, taking a loan against your stock holdings, how many people here have the ability to do that or can do it in an easy manner, are comfortable with that flow? Okay, if you have your bank, you're a high net worth individual, maybe you have access to this type of offering, but the reality is that the average person is not really able to do that. So we are enabling all of these workflows through tokenization and through the DeFi infrastructure that we've been building over the years.
I was actually about to ask you about that. Stablecoins is a classic use case. We know that real estate is being tokenized, but what are the new things that are being tokenized?
So I'm very interested personally about financing for SME type of businesses, again, emerging markets and so forth. Going back to the credit gap that I was discussing earlier, there is a lot of people, entity, businesses all over the world that need access to credit and don't have access to credit simply because their banking system is not reliable, they don't have access to, again, fiat currencies, etc., etc. There are companies in tokenization that are now setting up platforms to provide this type of niche financing to all of these different type of businesses. And they rely on stablecoins, they rely on blockchain rails, they rely on wallets. And the more interesting thing is that, as I mentioned earlier, there are shops that are basically coming to market with the sole purpose or funding this type of enterprises and exercises. So we're going to see more and more of that. I'm very passionate and interested personally about that, but you know, there is a variety of other use cases, of course. You know, people underestimate a lot of the work also that is taking place within banks and large asset managers, whether it's taking place on permission blockchains and so forth. This is all work that is preparing these institutions to come on chains on blockchain like, again, Ethereum, right? When would you have thought that a company like BlackRock would have launched a tokenized product on a public blockchain, right? If you think about that 10 years ago, it seems like something impossible, yet today it has happened. So the wind is moving institutions and capital in this direction. It takes a bit of time to make sure that the transformation happens.
Yeah, I agree. I think the next step in terms of tokenization is credit, specifically private credit. Blockchain is a liquidity expansion technology. It is an enabler for getting easier to liquidity. It's not an immediate solution for getting liquidity for any asset, because even if you tokenize a product that has no interest, it's not going to get liquidity, right? But it removes some friction so you can get to a decent quantity of liquidity quicker. And I think that there are some private credit verticals like car loans, credit card loans, microcredit, like Markus was saying before, that segments could come on chain. This is one segment. The other one is like migrating on chain some of the already liquid assets and providing a better user experience, and that's what we're trying to do with Backed.
Yeah, I also agree. So not much fighting here on this panel. I think credit is one of like the most exciting big use cases that now slowly moves on chain. Small company financing, private credit, all those examples that you've mentioned, I think there's a huge case there. And the credit gap that Emanuele was mentioning, it's like I think World Bank estimates in emerging market there's a $5 trillion credit gap. So there's actually a real use case for the technology that we are building. I was mentioning this research trip in Kenya, and it was so interesting to see that there is already today small stores that want to expand the range of basically product they are selling. There was a store owner we visited. She was selling like different types of vegetables and also want to add fruit to her range. And to do that, she needed a small loan. And the only alternative, because there's no banks active in that region, she had in the past was the local loan shark that was charging 30% of interest, 300% of interest per month in some cases. So it was like completely ridiculous amounts these loan sharks were charging. And now she actually gets a small loan on chain. She probably doesn't know which blockchain it is or what a stablecoin is. The loan she gets in this Kenyan shilling stablecoin I mentioned. And then from there, by now there's already infrastructure for her to either use that stablecoin loan to pay for product, but there's also a way, for example, into M-Pesa, which is a mobile money provider, which is very big in Kenya. So this also works. I think here, these things are already happening, so it's not super far out.
It's a beautiful use case. Love it. Since we mentioned like interacting with those new things being tokenized, like the credits, microcredits, my question is, are there any possible security complications? And basically what the users gotta pay attention to in terms of security while interacting with RWAs?
You mean like cybersecurity?
Not necessarily like in general.
I mean,
but we can also go deeper into cybersecurity if you want to make this.
I think that there are, of course, like security concerns. Like with every new interaction model, tokens are a new interaction model. You have a different piece of representation of your value, right? Today you have like, you started with paper certificates, then they moved to Web 2 kind of certificates, which is a website, and now you have these tokens that are partially visible on Web 2, but you also have wallets that are an hybrid component. This next step requires a modification and a different attitude of the users, which comes with with unknowns, because the user doesn't really know how to handle this new product, and it perceives insecurity because it's new. It could be like cybersecurity in terms of hacks and things like that, but also compliance in terms of, or taxation, in terms of how do you tax this kind of stuff. I think it's part of the job. It's actually a very important part of the job of us to explain how to tackle these risks and to mitigate these risks. Like, I don't think it's fair to sell a stock, tokenized stock to a client and then tell him, okay, now figure out yourself what the taxation is going to be, if there is any compliance risk, because in the end you have to support them throughout the life cycle of the product.
Yeah, so at the end of the day, it's not only about the technological issues, it's all about the supporting the person from the point A to the point Z. Like, it's not like how you only use the app, but like how you also deal with the taxation part, right?
Yeah, on top of that, I think that probably the three of us think about this the same way. We are not bringing to market speculative products that are just supposed to be traded and used around crypto. Of course, you can do that, but the idea is to bring to market reliable, trusted financial products. This is really what we are working towards. This is what we are bringing to market, financial products. That's why we have licenses to operate in the jurisdictions in which we can operate. That's why we are regulated entities, etc., etc. I think right now, crypto, of course, has a lot of short-termism type of mindset towards yield capture and incentives, but long-term, this is a reworking of financial services industry, and you need trusted entities to bring trusted financial products to the market. That's really how I think about it. In terms of risk, There is a variety of risk, otherwise it wouldn't be fun, of course, but you have, of course, smart contracts risk, you have counterparty risk. For example, in the credit example that I was making earlier, I'm deposited money in this smart contract. The smart contract is used and managed by a company. Okay, who is this company? What are they working with? They are doing the underwriting of the financing that we were describing earlier. Who is going to receive the financing? Who is going to receive this money? Right now, there is a lot of opaqueness through this chain, but over time, again, as it gets more institutionalized, that is going to be cleared up through regulation, through licenses, etc., etc. So there is a few risks, but for people, it's really important to take a long-term mindset, think about these as financial products, and make sure that they're doing their own research. You wouldn't invest in a 10x leveraged ETF, right? Or maybe you would if you understand it, but if you're just looking to put money in a safe investment, you're probably not going to do that. You're going to invest in the S&P 500. So same type of comparison here, just because it's a different way in which you access these products, just because it's a different asset class, doesn't mean that you need to take excessive risk.
Cool. And the last thing I want to discuss is obviously the future. How's the future going to look like? I know we're not prophets, but maybe we can make some assumptions on like what emerging trends and technological advancements you see influencing the future of RWAs, and how you guys preparing for the future. Markus?
Sure, start. So on our side, what we want to have is a stablecoin, for example, for every country in the world, so that we actually can execute on what we've discussed, for example, closing or helping to close the credit gap actually in all over the world. And I think there is demand for that. In future, I think you will see more and more of these end-user facing use cases like loans on-chain FX. Yeah, we now have actually the infrastructure. There's demand for it. We now actually have to work on distribution. So this is, at least in the short-term future, something we want to work on.
Yeah, for us, it's really about bringing to market the safest, most useful dollar in the space. Our view is that in traditional finance or in traditional markets, you usually have a few different types of regulators. You have securities, you have commodities, derivatives, and then you have banking and insurance products. We see Mountain Protocol and USDM specifically as falling under that banking and insurance product category. Your high-yield savings account, your high-yield checking accounts is falling under that banking regulation and let's say overseer. We are taking that same type of construct and again putting it on blockchain rails so that people not only have access to a dollar, but they also have access to these high-yield savings account, high-yield checking accounts through that same dollars. Of course, there is a lot of considerations associated with that and based on crypto operations around DeFi, around CeFi and so forth, but we are really laser focused on just bring a quality, trusted, safe financial product to market that anyone ranging from my mom to the most sophisticated hedge fund can use for their day-to-day operations. And again, to start, as there is this transformation from crypto into mainstream, it's going to be crypto use cases, crypto players, but again, examples like Opera, examples like Bakkt are already showing us that the two worlds are merging, and we want to be there for this convergence of Web 2 and Web 3.
Yeah, I mean, for Bakkt, I think stocks, definitely next step. In the real world asset space, there are very specialized companies that are vertical on T-bills and on yield, on providing yields from fixed income like Mountain, but like other players. So we think that our opportunity sits where we have a competitive advantage, and which is stocks right now. For the wider market, I think the explosion of stablecoins, which means getting to maybe 1 trillion of stablecoins in circulation. That's where I think at that point stablecoins will be a significant player at governmental level, and crypto would ubiquitous without knowing. Like people wouldn't know that it's a crypto technology, but like they don't know that they are using relational databases now that they use Amazon. I think that's the analogy.
Cool. The last question. How can you describe the future of RWAs in one word? Markus.
I think big.
Okay.
Exciting.
For me, it's institutional, in the short term at least.
Nice. All right, I guess we can wrap this up. Thank you so much for the conversation, and thank you for being with us. Thank you.
Thank you.